before I start, I want to address the elephant in the room, which is the underperformance that your funds have seen in the last 1 year. What would you want to say about that?
Equity market is long term. Okay. Asset class is long term and investors are long term. Sector and stock can be short term also. Okay. What we have to understand is that how you play the entire cycle. Nobody can predict the market 100%. Let's talk about last 5 years. All the scheme which Quant Mutual Fund has, either they are number one or they are number two.
Of course, you've done much better in the 5-year period, but in the last 1 year, you have done much worse. So do you think as an investor, of course the upside is much higher, but the downside protection is something that is a bit worrying?
No. So if you see our numbers, okay, so even in flexi cap, our upside capture ratio is, if I'm not wrong, is 1.26. Okay, anything above 1 is positive. Okay, and similarly less than 1 is the downside. So we actually fall in less. Now the moment you try to picture, take 3 months, 6 months, okay, it's a skewed structure. Since we are saying that we are long-term investors, equity and asset class is long-term investors, so at least you should look at 5 years perspective.
So if this is a risk-on phase right now, how would you rebalance your portfolio in 2025 for an average investor? Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to the Money Mindset. Now our guest today is someone who has had a phenomenal run in the market, but that's in a bull market. Since the bear phase has started, his funds have underperformed. So it's going to be very interesting for me to analyze his investment philosophy. Sandeep Tandon of Quant Mutual Fund is here with me. Sandeep, thank you so much for joining me on the Money Mindset.
Yeah, thanks for calling us.
You know, before I start chatting with you, I want to tell our viewer that Quant Mutual Fund has grown substantially over the last 5 to 6 years. In fact, now sitting on an AUM of almost 95,000 crores as of December last year. But the most interesting part is their strategy is very different from most fund houses. Their returns have been phenomenal if you map a 5-year journey. Of course, the last 1 year they have seen underperformance, but their strategy is style agnostic, theme agnostic, very adaptive, fund management. So I want to know a little more about that. Sandeep, before I start, right,
Okay.
I want to address the elephant in the room, which is the underperformance that your funds have seen in the last 1 year. What would you want to say about that?
See, if you have to understand our philosophy first of all, when we say equity market is long term, okay, asset class is long term and investors are long term. Sector and stock can be short term also. Okay, what we have to understand is that how you play the entire cycle. In risk on, we play on front foot and generate extra alpha, which will help us in difficult time. In risk off, we lie low, just protect the capital. That's a thesis. Okay. Now, if you look at it's not be fair to just look at 1 year, because that was a risk off period. In risk off period, we will become extra conservative, okay, to protect the capital, okay. And nobody can predict the market 100%, okay. We are always say that mathematically we run a lot of models, and we say with the help of predictive analytics, we are only right 72% times. We are always wrong 28%, okay. But 72% itself is a very good number for your success, okay. So now if you look at, let's talk about last 5 years, okay, 5-10 years people talk about. Now 5 years, all the scheme which Quant Mutual Fund has, either they are number one or they are number two, okay. I will say 90% schemes are number one and 2 schemes are in number 2. Now you tell me you can't have a better track record. Show me one mutual fund who has all in the top quartile or number 1 or number 2 position. So we have achieved it from nowhere, okay, and we build it from scratch. If you really look at, we implemented our VLRT framework somewhere in March, April 2020. Since then, look at the outperformance which we have built. Our small cap peak performance was close to 900%. Today also is close to 800%. Even
Since
hybrid
2020.
fund, 2020, from the April, you can take, let's say, COVID low onwards, when we measure that, is a remarkable. Even hybrid fund has given 300%, 500% return. So if all the schemes which we have 5-year history, they have generated 300 to 900% return. I think it's extraordinary. Why one has to just look at 1 year perspective, and I will mathematically can explain why it works. Okay.
So I think the problem is that with retail, right? Most
Yeah.
of retail always enters in the fag end of the bull market. And in the last 1 year, we've seen retail pump in a lot of money, and that's where the disappointment began. So the question that a lot of viewers have, a lot of people who are investors in Quant MF have is that in times of a bull market, of course, there's huge outperformance. But in times of a bear market, is there any way to protect risk further, like to prevent such a big drawdown in the
No,
portfolio?
you have to understand two things. See, the problem is everybody look at absolute return or relative returns. Risk adjusted returns is only on paper. Okay. Best of the wealth firm also don't look at it. Best of the journalists don't look into it. Okay. Because that is complex work. Okay. It's there in our fact sheets, but people don't. Now, if I have to look at the risk adjusted returns, okay, in any category, we are decisively leading the charts. Whether you talk about Jensen Alpha, whether you talk about Sharpe ratio, Sortino ratio, downside capture, upside capture, or the ratio of that. So if you look at our 5 years performance and data, we look at, you will see when market moves up, our upside ratio, capture ratio is higher side, more than 1. And downside is actually less than 1, which means that's the way statically it has to be. Okay. Which means the downside comes, we have fallen less, when upside comes. Now, 1 year may not be a right approach because we have to understand how we operate. We operate through a thesis of adaptive asset allocation. We're trying to adapt the market which is prevailing globally. Okay. Now, let's go back in the history. July 2024, we said is a risk-off period for India. Okay?
I remember that.
And we were the first house. None of the economists or strategists in this country has said there is a problem. Okay? All the problem got visible closer to December quarter or the January quarter. Okay? That's the time people felt that something is not right in India, growth is slowing down. Now, we as a house of a macro believer, where we capture qualitative, quantitative and behavioral data, where high frequency data were showcasing is a risk off. Now, if you look at as a student, as a money manager or as a risk manager, okay, we always say we are in the business of risk management. Returns are byproduct. If you manage your risk, returns are there. Okay. Now, as a money manager who is like, I'll say paranoid about risk. Okay. What we will do? We move from illiquid to liquid, high beta to low beta, and small and mid to large cap. This was a strategy any money manager should do. If you see
in July 2024,
when you see a risk off phase. Okay. Now, in risk off period, it went well, but market still rallied. So small and mid still rallied till September, okay, October or so. So by September, October, we have already shifted towards large cap in a big way. Okay. Now come September, what happened? It's a specific, I will say, event risk played out, where China actually launched a massive stimulus. Okay. And money overnight shifted towards China. Okay. And all the FIs sold the domestic Indian stocks. And what they have predominantly large cap. So our portfolio was skewed towards large cap, and we saw massive selling coming in September, October. And that was the quarter, particular quarter, October quarter, where we saw significant impact on our portfolio. The strategy was right, but these are event or unknown risks which nobody can time it. Okay. So it got affected. Now, if you look at come January 2025, okay, we are actually leading the charts. Okay, last 3 year performance has been extraordinary for us. So we are back in the quartile 1. Okay, see what people have to understand how you manage risk on risk. I will give you one more example. Okay, January 2023, something similar situation. That was time this Hindenburg episode also happened. Okay, we have small exposure of Adani 6-7%, 6% something, but we have a large exposure of PSU, more than 20%. Okay, now Adani was the small fiasco. The bigger collateral damage was PSU, and we were there. Okay, now that was also unknown risk which you hit us. Okay,
but just to stop you there, right? That was another question that I had. The one I think complaint, maybe if you want to say, with quant mutual funds is that you have very high concentration.
I'll explain that also.
Right?
Let me just complain this.
So you think that was a wrong strategy?
No, not at all.
Okay,
I'll explain. Yeah. Okay, I'll explain that also. So we have a concentration there. Okay. Now, so obviously January we were impacted 6, 7, 8%. Okay. So if I'm not wrong, March 2023 were the worst performing fund in across all the categories. Okay. In risk off period, the mistake most of the money managers make, they try to be aggressive and try to generate alpha. In a risk off period, that's the most dangerous strategy. If strategy fail, you will never able to come back. Now come September 2023, we have written also in our fact sheet and the predictive analytic note saying that it's a risk on rally on the cards. Okay, and risk on rally played well. Come January 2024, we are back on the chart as a number fund house in all the categories. So we were down 6 to 9%, we were up 6 to 9%. Okay. Now you look at it, just took 3 quarters or rather 2 quarters actually to recover. Okay. So the challenge is how you manage risk on, risk off. If you are patient, now let's say January onwards when we say mild risk on, March newsletter we says India is a risk on. Okay. Again, last month I said risk on, globally risk off, India risk on. On risk on rally, we have captured again. Okay. So what is very important to understand the cycle.
Market cycle.
Okay. And these are global macro data. We are not astrologer to tell you this is the way. A lot of people do postmortem analysis. After fall, people say, oh, that was a risk off period or risk on period. See, when you are in the business of risk, you have to be ahead of the curve.
So as on May 2025, are we in a risk on for India? And if yes, how long do you think this phase could last?
Okay. So again, we will not able to comment how long. Okay. But since we specialize in the inflection point, extreme inflection, I am a buyer. Extreme inflection, I am a seller. So January we said mild risk on. Like how we July we said mild risk off, and September, October we said is a major risk off. So January we said mild risk on for India, and last month we say it's a normal risk on. We are still not saying aggressive risk on, but we are in risk on. Like last fact sheet, if you read, we said risk on for India and risk off for global market, where we said positive for Bitcoin, positive for India, and we said ugly bottom in US is still pending. We were very early to talk about a risk off period in January 2025 for US. When Mr. Trump came, everybody was gung-ho about US market. People have written off emerging market, people have written off India. It's all about DXY rally and US market. We could be the only fund house or could be only strategy in India. We have said US is a euphoric phase, extraordinary money flow, risk appetite is speaking out, liquidity is shrinking. And I said on multiple channels, 15 to 20% fall in US market, particularly NASDAQ. And it played out. And I still believe this is a pullback rally. Big, ugly fall is still pending in US. Again, how we do it? This is with the help of predictive analytics. We say we are data-driven house. If data is showcasing, then as a student of numbers, then I have to follow the discipline. Okay. I always say 28% time we don't get it right, and mathematically or statically you will never get it. It's a game of probabilities. Okay, you can't have 100% probability in your favor all the time. So it's not fair to say every quarter, every year you should be leading the chart. Okay, but if I look at from 5 year, 10 years perspective, I think we have done a remarkable job, and Quant, to be candid, is a unique case study in the industry.
Yeah, it is. I mean, it's very unique because you don't follow all the conventional wisdom of investing, right? I mean, just to give one example to our viewers, I think Warren Buffett has always taught us this buy and hold strategy, although he doesn't use it too much himself. But you don't believe in buy and hold for long term. You don't believe in any sectoral themes. You don't believe in any. You are theme agnostic, sector agnostic. So tell us a little bit about what is your investment philosophy.
Okay, so it's not fair to assess that we don't believe in buy and hold. It depending on the which phase of the market we are in. Okay, so let's say if I have to go back in the history and I tell you, let's say June 2003 when bull run started globally. If we were in that phase lasted till end of 2005. That is the phase buy and hold. Okay, India 2012 till 2015 was clearly buy and hold. Okay, similarly, so it depending on which phase. So let's say I said last year the easy phase of bull run is over in June 2024. But I said it's a bull run. It's not a bear market. We are in decisive bull run, but difficult phase of bull run. So we actually quantify the cycles also. Okay, how long the cycle can be, and when you get this inflection point in these structure cycles or the cyclical bull run, when we try to capture through behavior numbers, we are able to quantify. Now, when we talk about what thesis we follow, so we believe that we bring a very unique thesis of dynamic style of money management. Okay, now we all say that it's a changing world. World is very dynamic. Data points are changing on daily basis, rather minute to minute basis, actually changing. Okay, Now, can be fair to say that despite knowing that world has changed and changed with a different pace, or still changing with a different pace, and we are not able to cope up with that. But our money management style will be static. That never happens. Okay, that is the problem. Because we have, and not a comment, but I think we have grown with multiple mistakes. This is one thesis long term. Why long term? Because managing long term risk is very easy. In 10 years, if you are 3 times wrong, your average will be still okay. You say, I'm long term. But if you manage your short term and medium term risk better, not only you protect your downside, you actually generate alpha out of it. Okay. So it's a risk business. So if you are an investor, let me ask you a very simple question. Do you have everything is have a long term need? You can't tell your kids you will go holiday after 5 years, let me accumulate something. Correct? Can you tell them even wait for 1 week for a party? Correct? No. So all investor has short term, medium term and long term needs. Now we are addressing all these different needs by saying everything is long term. Okay. Now this can be very dangerous strategy, because if you have, let's say, constructed your portfolio keeping in mind everything long term, and in short term and medium term there is a pain in the market, then your entire portfolio will going to suffer, because everything you have built long term. And that is the problem which we have understood with our own investment in the past. And that's the reason we say in Quant, we diversified in such a manner. So we have a high risk, medium risk and low risk portfolio diversification in terms of stock or sector selection. Similarly, we have duration risk also we try to capture. Okay. So we try to capture long term, or let's say decadal view, long term view, medium term view, short term view and even near term view. Okay. So we try to capture, let's say, depending on the scheme. So we actually try to, is a very interesting way we dissect this. Like if you have a 3-dimension approach. So x-axis is your risk profiling of a scheme. Let's say example, a quant small cap fund, high risk. So it's a high risk scheme. On y-axis is your investment horizon. Small cap is meant for 5-10 year perspective. You don't buy small cap for 2 months or 6 months perspective. Correct. So again, product is long term, duration is long term, and z-axis is your SID requirement of the SEBI. So based on what you have to keep, that's the way we design. Now, if you design everything in this manner, it will not work. So what we do within small cap, our 70, since a long term focus fund, 70% or 65 to 70% will be the long term portfolio. 30 to 35% will be medium term and short term portfolio. So I'm able to address medium term and short term needs also. Okay. So similarly, if we have a fund like called quantamental, a quantamental fund. Okay. Now it's a quant fund, but we have defined the investment horizon is few quarters, 6 months. So we invest only from 6 months perspective, that I have investment horizon only 6 months.
Is that like a momentum fund?
Momentum, we have third one. Okay, we have, that is the 1 quarter horizon. Okay, you can get into that also. So it's a 2 quarter horizon. Here we will only invest, assuming I have only 6 months window. Okay, so my 70% is medium term and 30% is long term. In momentum, we have also a momentum fund where 70% is short term and 30% is medium to long term. So depending on which scheme you are selecting, we are trying to offer. It's not like Quant is offering, like in a traditional mutual fund you go, all the schemes are long term, which is not the case in Quant.
So since you're talking about traditional mutual funds, just to give you an example of, say, your flexi cap fund, right? In the last 5 years, I think you've given a return of around 20% since COVID.
5 years is 38% or 36%.
38% in the flexi cap fund.
Yeah.
On an average, if you compare some of the more traditional funds that you're talking about, whether it's HDFC flexi cap or Parag Parikh flexi cap, 5-year returns would be about 20% in those funds?
Less than 20%.
Less than 20%, okay. So, of course, you've done much better in the 5-year period, but in the last 1 year, you have done much worse, right?
Yes.
So, your fund, I think, flexi cap has fallen 1% in the last 1 year, while some of these traditional funds are still in double-digit growth. So, do you think as an investor, right, of course, the upside is much higher, but the downside protection is something that is a bit worrying?
No. So this is again, this is a typical human cycle. Every investor peak of the cycle at the highest point, you have highest risk appetite, and everybody is a long-term investor. Okay, but in reality, he is not a long-term investor. That's the reason I always say, you go back and check how you reacted in 2000, what you did in 2008, what you did in 2018
2020.
or 2020, what you did. Instead of saying that I will look with my wealth manager, or I am saying I'm changed now, I'm long term. No, you are, because that mindset doesn't change. It's an individual temperament. Okay. So you have to assess your risk appetite. Now, when I say, let's talk about this question, we capture this data point also through upside ratio or downside capture or upside capture ratio. So if you see our numbers, okay, so even in flexi cap, our upside capture ratio is, if I'm not wrong, is 1.26. Okay, anything above 1 is positive. Okay, and similarly, less than 1 is the downside. So we actually fall in less. Now, the moment you try to picture, take 3 months, 6 months, okay, it's a skewed structure. Since we are saying that we are long-term investors, equity and asset class is long-term investors, so at least you should look at 5 years perspective.
Okay.
10 years also good, but it's a slightly long-term. 5-year cycle is good enough to capture, so it's not fair to say that in the bear market we have done bad. In 5 years we have seen bull market, we have seen bear market also. Okay, and in 5 years we have done extremely well. What is important to capture, how we assess a risk on or risk off phase. Okay. Now, in risk on phase, if I perform the similar manner like traditional fund houses do, their portfolio don't change much. So they will underperform. So now in risk on period, we are outperforming, they are underperforming.
Correct.
Okay.
Yeah.
The thesis is that my portfolio will change, or I say dynamically I rebalance my portfolio based on the risk on risk off environment. It's a part of a risk mitigation strategy. Okay. It's not like we have learned few wrong things, churned. This is another thing. People say they churn a lot. Okay. Is there any problem in churning if I'm generating alpha out of it? Absolutely no. Okay. You looking at absolute return rather than looking at my churn. If churn helps you in reducing your risk, then churn is actually good. Because this is the way we have groomed up. Okay. Because this is the way our grooming has been done, because this is a few wrong concept we have built over a period of time. Okay. Now, if world is so dynamic, if you have this buy and hold strategy, it has failed globally. It has worked only in particular cycles. If you are in that cycle, I will also implement that phase. Okay, but we think we are not in that phase, and hence we are not implementing.
So if this is a risk on phase right now, not aggressive risk on, but
Yeah,
moderate risk on,
it's a moderate risk
how
on.
would you rebalance your portfolio in 2025 for an average investor?
So what we do, if you really look at till December or January, we were running a very defensive portfolio. Okay, very low beta defensive portfolio, which is largely consumption names. Okay, defensive portfolio. Okay, now right from January we have started changing our portfolio. We are moving towards growth. Okay, now growth can be expensive. We are very okay in a risk on period. We don't mind high beta. We don't mind. What is important? Growth. Growth is the structure change which we brought in our portfolio when we have shifted. Now, another important thing is that.
So when you say growth, what can you give me some examples of sectors which are high growth sectors? If you'd want to, talk about.
No, so
stocks.
let's say, so again, it's a combination. Okay. Now, when we say India risk on, globally risk off. So what is my strategy? That entire focus is on India centric companies. So we have skewed our portfolio towards large infra names. Our portfolio is skewed towards Indian hospitality, hotels and hospitals. Okay, we are skewed towards our consumption names, which include some of the FMCG.
Hotels and hospitals.
Yes, both. The entire hospitality.
Okay.
Right now we have a lot of hospital in the past. Right now we have built more hotels. Okay, because a new sector. Okay, now if you look at this debate keeps on coming on the consumption side, that consumption is not there. Actually, it's not true. Okay, because we only track the listed companies. It's there in pocket. If you go to Amazon, you will get a very good first rate. Now, same thing. Look at Reliance. Campa Cola has grown significantly, where Pepsi has degrown. Okay, so it's like some segment has started growing. Reliance Retail, many product, their own basket, if I'm not wrong, 11,000 crores. So they have gained that market share at the cost of Lever, Nestle or Britannia. Somewhere they have suffered and they have grown. So it's not fair to say the consumption has slowed down. Maybe consumption has moved away from the listed space to the non-listed or non-disclosed portfolio. Okay, So we have to identify the opportunity rather than generalizing the entire thesis. So again, consumption is the focus area. We have skewed our portfolio towards now with NBFCs, financial services, less bank, more NBFCs. So we have healthcare companies, insurance companies, and NBFC also, because they have gone down to beaten down and neglected territory. So our entire, Sonia, practically speaking, our entire thesis is not momentum trading, which a lot of people think so. Okay, we are actually opposite of that. We are extreme inflection points. So we call ourselves as a inflection point strategist. Extreme inflection points, I'm a buyer, and extreme inflection point, I'm seller. July 2024, everybody was bullish. We were first to move out from India. Okay, like September 2021, everybody was bullish on US, new age company. We sold all tech. Similarly, January 2025, we said US is bad. We moved out from tech completely. Okay, so taking, see, sir, when you call yourself an active money manager and take a fees for active money management, you can't offer quasi-passive product. And that is my problem with the industry I have. Okay, so people 70-80%, you will analyze the portfolio of the industry, you will get a 70-80% is aligned towards particular indices. So you're mimicking 70-80%.
You're mimicking an index fund, basically.
Correct.
Yeah.
And 20-30% is your portfolio. We are trying to generate outperformance. Now, this is the thesis. Globally, people were very smart. They understood. The investor understood this is what is going on. That's the reason they moved to a passive fund, where the charges are insignificant.
But if you look at over 15, 20 years, passive funds have always outperformed active funds, right?
No, not necessary. So in an easy phase, active fund, passive fund will do better because overall your cost structures are low. Okay, and in the trended market, you will logically make more money.
Yeah, correct.
But in a difficult phase, active money managers will deliver better returns.
But it averages out, right? Over.
So again, I'm not a believer of this thesis of average. I'm more interested in rate of change. You know, the spikes are more important than averaging. So I will look at the particular segments. Right now, if I say from, let's say 2025 to 2030, if I have to talk about next 5 years, I think it's a challenging phase of global markets. In the challenging phase, passive fund will not do well. So I believe that passive fund cycle has peaked out and now true active money managers will come. So we as a house are true active money manager. That's the reason if you look at our correlation with index in terms of R square is on the lowest. Okay, we don't mimic indices. If I'm taking active management fees, I will deliver an active product. I will not deliver you a quasi-passive product. Okay, and there's a way your question comes about the concentration risk.
Yes,
okay?
yes.
So
actually, it's twofold question there. Concentration risk, not just because of the Adani group, but also because you've had, a large exposure to, say, Reliance, to Jio, and all of that at a time when the stocks were not really performing. So that is another complaint.
Okay, I'll answer that. Okay.
This show is full of complaints.
No, it's okay. It's better to should have a clarity rather than people not understanding. The problem is the understanding part. Okay. Now, when you talk about, when you look into any portfolio or money manager or any professor, you will talk about diversification. Okay. So diversification statically is good, but extraordinary diversification is bad for your portfolio returns. Okay. There's no focus. You have just diversified too much. Lot of people manage very large number of stocks, 60, 80, 200 stocks in their portfolio. It is impossible for one single money manager or as a house also to track such a large basket, which means there is no focus. It's a share out of fear. Okay, and I'm very candid to say it, of fear you have unnecessarily diversified. You are not running when we run a skewed portfolio, it's also depend. If I'm a risk on environment, I will diversify my portfolio. In risk off, I will concentrate my portfolio.
Because in a risk on, everything does well.
Yes, in risk off, I have to protect my downside. And if you see, my portfolio will be more concentrated in a risk off period than that was the case with last year. So we think it's about conviction. Conviction, where is conviction? Like if you have a skewed portfolio, it comes from conviction, and conviction comes from data analytics. So we are data analytics firm, we are data scientists in that manner. Okay, so we take calls through analytic rather than saying, how markets are looking at. So, and again, the size which we build exposure, you only get when they are in the extreme ends. So if you really look at right 2020-21, we are saying this something has changed from September 2021 from growth to value. We are very quick to migrate, okay, towards value. That's the reason 2022 index has given negative return. Quant was the only fund house given positive return across all the schemes, including the small caps of more than 10. So we have given 10 to 30% returns in a year, calendar year, which has negative returns for the market, and 90% scheme underperformed. Okay, so it's very important how you shift. So we said that erstwhile admired territory. Today, if you ask me how I'll play, so in last 2 years, whatever stock has done extremely well, all admired territory of last 2 years stocks will underperform going forward. But all erstwhile outperform or admired territory stock like Asian Paint is a very classic example. Okay, Bajaj Twins, DVs, just for the name's sake, they all corrected D-marts of the world. They were erstwhile admired territory. They have corrected sharply. Those are the names which we build in our portfolio. Okay, so it's not a contra call. A lot of people think we take a contra call. We don't take contra call. We take data-driven call.
But do you consider, I know for a fact that you don't look at fundamentals
No,
as
we look
much,
into it. No,
do you? But
no.
then in Asian Paints case, there is a huge other competitor that has come into the market now.
Okay, so I'll answer
VLRT.
that. Okay, so let's look at when Asian Paint and Grasim entered. Okay, we moved out from Asian Paints and we have a large holding of Grasim. Even today also we have a large holding of Grasim. Okay, now if you understand our entire framework, how it works, it's a VLRT framework. Okay,
Tell us a little bit about
okay,
VLRT. Yeah.
how it works.
In the context of Asian Paints.
Okay,
Yeah.
so first biggest myth, people say you are not fundamental house. Okay, I think in life everything is fundamental. If you say what people refer to fundamental is the valuation aspect. Okay, everything is actually fundamental. Okay, so you think a currency trade doesn't do any fundamental work, or economic trade person does not do a fundamental work. Reading balance sheet is only fundamental work. That's the way industry defined. Let me correct that. Okay, what industry refer or the media refers as a fundamental work is pure valuation analytics. So we stand for valuation analytics 1/3 weightage, which we capture all the company's balance sheets, all the P&L, cash flows, or free cash flows, all as much historical data as we can get. So 1/3 is valuation analytics. 1/3 is liquidity analytics. Liquidity is a very important, it's a lifeline. So if you look at when COVID happened, okay, anything got changed in March or April 2020? Nothing. People felt nothing has changed. It's just an event played out. I'm a buyer for decadal perspective. But something got changed. People have not understood actually the fundamental of the company got changed, and people realized after 3 or 4 years that something got changed. Okay, nothing was visible at that moment. But what was visible? The liquidity collapsed, or risk appetite collapse. Okay, and that is a statistical measure or a mathematical measure which is largely economic data and we can measure. So what we spotted in March 2020, the risk appetite collapsed and it was like 40 decades low. Post-World War, that was the lowest point. It was lower than the Lehman moment. Okay, the liquidity was lower than the Lehman moments and risk appetite was one of the lowest. So it's a very deadly combination when risk appetite and liquidity is on the lowest and starting inching up. That's a perfect background for a bull run. When liquidity peaks out, risk appetite peaked out is a classic thing that market has peaked out, which happened in September 2021 for the growth stock. So what is very important?
So in Asian Paints case, valuations are cheap.
Yes.
The liquidity is
Now it has fallen. So
yeah.
liquidity, how it works is a very thing. Liquidity is high at the peak of the cycle and liquidity is the highest at the peak of the cycle. Everybody is sucked in at that time. Okay, and liquidity is also high at the bottom of the cycle. People give up. They get capitulated. Somebody is holding for 10 years, 5 years, virtually will capitulate at bottom of the cycle, and people like us will wait for that opportunity to participate. So liquidity is from extreme low should start inching up. Sentiment extreme on the lowest point. They are in the most hated zone territory. And valuation attractive. That's a combination which we look at. Okay. So VLRT is 1/3 valuation analytics.
What is T?
T is the timing analytics. Okay.
Okay.
Okay. And timing is a risk mitigation tool. It's not a trading tool.
Okay.
Timing analytic is a function of all three analytics. So timing analytics is a function of risk appetite analytics, is a function of liquidity analytics, is a function of valuation analytics. So like in our Veda, you have 64 dimensions. So we work on these 3 dimensions. Then you can split down further dimension sort of thing. So we work on a concept of multi-dimension. Industry work on a concept of unilateral or one dimension. Okay, only one dimension. Entire thesis revolves around valuation, valuation, and valuation. Okay, for us, valuation analytic, liquidity analytic, risk appetite combination. Okay, now it's also very interesting, like how in March 2020, valuation not change. Our weightage also changes dynamically. Okay. So at any crisis time when you have something like this, the liquidity and risk appetite weightage was 90% and the valuation was only 10%. Because that has not changed, or even it has changed, it's not visible to you right now. You will realize the pain or gain much later with a lag of few quarters. And this is what happened. Rural economy after 4 years is able to come back. Okay.
Yeah.
So it's I think what is very important, like, like you talk to anybody, you'll talk about earnings. Okay, everything is all about earnings. Earnings is important, but multiples are also important.
But if there's
Okay?
no
And
earnings
liquidity is
growth,
important.
if there's no earnings growth, like Asian Paints has been growing in low single digits for many quarters now.
So
Isn't that a red flag
no,
for you?
we think, just for example we think we are at extreme levels. It has been, that's the reason it is
It's factored in.
It's fact. So we have to understand up to what extent is factored and what extent is not factored.
Exactly. So there could be years of underperformance also, right?
So it has been
Which has
underperforming.
which has happened, yeah.
So I'm not saying you go all out.
Yeah.
Okay. But I'm saying we have not bought. I'm just trying to give you example.
Correct.
These are the characteristics which we look at. When it hit everything in our thesis, we will be buying. Again, we are not going to buy all in Asian Paints. We will buy token.
Correct.
Okay. As data points change quarter on quarter, we keep on increasing our exposure.
So can you give me some more examples of which stocks are now fitting in your VLRT framework?
So, I think that is also very dynamic.
Yeah.
Okay. Okay. So currently I said infra is a thesis because we come from deep macro, global macro to micro. Okay. Because it is not fair that we are bottoms up, because bottoms up you don't get answers. Okay. A bottoms up is important for me. Industry follow bottoms up, we follow top down approach because we think in a global world, and Mr. Trump mood can change tomorrow morning.
Yeah.
It's very important to understand the DXY movement. It's very important to understand crypto. A lot of people say, what I have to do with crypto? I don't even trade. I'm not going to trade ever. Something which I don't understand. But you should understand, because crypto is a risk, is a new risk appetite indicator for young generation. Okay, like last fact sheet we wrote about crypto. Okay, the crypto will move up because when you have uncertainty, that is considered as a safety. Okay, and more uncertainty in US, more clarity in crypto.
You were telling me the reason why Quant MF has, kind of underperformed in the last 1 year, but little bit of your calls went wrong according to you. Is that a fair way to put it?
No, I will say, so in July when we spotted that it's a risk off period and we have given extraordinary return in 5 years. Naturally, we all felt, let's be slightly more conservative. Okay. And again, we were approaching that 1 lakh crore psychological mark. I always said that when you are like close to a century, you try to become slightly slow. You like to play it safe. 5 years extraordinary performance and we turn slightly more cautious than what we should be. Okay. And obviously, when you become more cautious and market rally till September, October, you bound to underperform. Okay. And we were very early. But again, from a risk perspective, we don't have any regrets, because that was the right strategy. Let's say in January, somebody could have realized it's a risk off period. Now I want to exit small and mid. It was a task where we saw right from February 2024, the impact cost in the market was rising, since we are a student of numbers. And if impact cost is changing, it means it will affect our volumes in a big way, because if my switching cost is going to move up because of various regulatory reasons and the environment, we felt to become more cautious than what was needed. And sometimes it's like it is very difficult to measure everything perfectly right. I said, like one of my oldest distributor put it very nicely. He says, Sandeep, your diagnosis was 100% correct, but your prescription was not apt.
Okay. The medicine that you took was not correct.
Correct. So it means the stock selection or whatever we felt
Went wrong.
was, I will not say went wrong, has not worked. Okay. The thesis was right. I have to be low beta stock. I have to be high liquid names. I have to be large cap and mega large cap, which is playing out now. It's okay.
But it's candid of you to actually admit that your stock selection may have not worked, and
So I
that's
tell you
why.
how we work the entire framework of VLRT. A lot of people say this is something, oh great, we have created. I have never seen in any, most of the learned people talk about, they only talk about their success. We also as a house always talks about the failures also. We say VLRT framework has been built with our experience and our failures. Okay, it's not about the success story. Based on the failures, we have improved the system. Okay, and as a failure, it was our personal money which we lost. So I have seen a lot of people learn at the cost of public money. I said very openly, they learn at the cost of public money, then they set up their PMSAI shop, where we have learned at the cost of our own money, and then we manage public money. So that's a big difference.
Interesting. So, I do have a lot of viewer questions, and I had opened up the floor for some questions. Very interesting questions have come through. So, I want to take some of them. But before that, just to understand, I do know that you started your journey during the Harshad Mehta scam, and you've seen so many cycles, right? I want to understand from your end. I mean, you have worked with some of the best minds in the business. You have seen so many of these cycles. What has your biggest market learning been so far?
So I think the learning is that you should able to change yourself with a different pace. I have able to live up to certain expectation. Answer is yes. But I also feel the way industry is changing, analytic, the speed of trade. Like today you are competing with machines. Okay. And sometimes I struggle that we are unable to cope up with the pace with the changes are happening. And that is, I will not say regret, but we find it something extremely challenging. So much data to capture, so many things to read, so many things to analyze, okay? And time is limited. And then you have machine work competing with you. So we have already built our own tool, which we call it predictive analytics, which is there for longer period of time. And with the AI coming to picture, we have also started adopting a lot of things. So we are also improving our efficiency in a big way. Okay, that's the only biggest learning I think is all about, that you have to
stay
change.
agile.
Yes, you have to. I call it, as I title of my book is relevant. You have to be. You have to keep yourself relevant all given point of time, and that is the key learning.
And do you think, I mean, of course, the last 1 year has been challenging for you. Of course, last 5 years, the performance has been great.
I will not call it challenging. It's a part of a cycle. Okay. A lot of people say, oh, underperforming. No, underperforming is also part of strategy. When we know, let's say it's at 23, we are the worst performer, we came back. Now again, this year we are leading the chart. So it's very important to understand. You have to accept. I will not call it underperforming. I'll call it a strategy. Okay. As a strategy, if we say it's a risk off period, what I will do? This all step which we'll do. Sometime it will work, sometime it will not. We always say 28% time we always get it wrong. 72% time it has worked. That's the reason 5 years we are the leading in most of the categories. How many mutual funds are leading on 5-year basis? Okay. If I look at some 8, 10 schemes, we are leading in most of them. So it's a very uniqueness in that case. It means whatever VLRT framework we have built, or we talk about adaptive asset allocation approach, or predictive analytic thesis, has actually worked so well for our investor. That's the reason we have nearly 96 lakhs investor. And that is also a uniqueness. In 4 or 5 years, we have built this large retail base. So it's not a failure, it's actually a big success.
No, of course, 100%. Okay, so let me just take a couple of questions because the questions are really interesting. And I mean, I'm sure most of these people who have written to us are your investors per se. So let me try. The first question says that I've been following up, invested in Quant, small, mid and ELSS for the past 3 years. Despite initial outperformance, the fund has been abysmal for the past year or so. How much of a drawdown are we looking at henceforth, and what will it take for Quant to become the rising dark horse again?
So mathematically, okay, if you are behind one quarter, whatever reason, if you have started underperform that quarter, so it takes time, okay, and you have 2 or 3 quarters of underperformance. So it will take 2 or 3 quarters to come back. So it's not that it's going to come back tomorrow morning. It's not going to happen. Now, if you look at YTD returns for this year, we are leading the charts. Last 3 months, 6 months, our underperformance has come down. 3 months, we are actually deliver extraordinary returns compared to the industry. Again, I am talking about. So it's a process. So it takes time, but we as a house are not in a hurry. Okay. In a risk on period, we will catch up. In risk off period, we will lie low. So again, how you look at, if somebody is looking at just 1 year perspective, then the assessment itself is not correct. See, when we say equity as an asset class is long term, we as equity investment is long term, just why not 1 year? Just one. Some people choose 6 months. Some people write to only this particular date to this date you have underperformed. Okay.
Yeah.
What about 5 years? What about 3 years? Okay. So I think what is very important as equity, we look at 5 years. People should not look at,
Look at 1
six
year.
months or 1 year return. You look at 5 years, we are leading the charts. Okay. There will be phases where as a part of a risk off period, we might underperform. So it's not a failure, it's a part of a strategy.
It's part
Again,
of a
how you
strategy.
look at, I
Yeah.
look at as a strategy, not as a failure.
You've spoken about that before. The churn within Quant MF has reduced quite a bit as compared to earlier times. Have they changed their strategy?
No, strategy is not changed. What I was explaining you earlier, right from January, February of 2024, the impact cost was rising. And over a period of time, when the impact cost rises, basically it means any sector rotation, stock rotation will cost you more. Okay. And a risk off period, there was no need to churn. Okay. Now, this January, February onwards, the impact cost is slowing down or it is coming down, which means, and that's the reason you see month on month our churn is also rising. So we are not significantly away from the market. We always say Indian capital market depth and breadth both are rising, but there will be phase. Last year, because of a lot of regulatory changes, the impact cost moved up, okay, and money shifted towards China also. So overall volumes have shrunk a lot. So naturally, we will not going to create volumes on our own because of regulatory changes. If something is thing, we will prefer to lie low. Now again, it is building up.
Bhaskar has written to us saying that I have invested in his momentum fund, considering they are the better fund house in this strategy. But the fund holding and churning is nothing different from their other quant schemes. Please ask him about this fund in specific and what's the differentiating factor.
So as I explained, when overall impact cost is high and volumes are low, you cannot implement the same strategy which is this scheme has been designed for. So sometimes you also have ability or you should lie low also. Like we always say, sometimes you have to take 2 steps backward also to move to the next level. So that was the need of the hour. Now activities again building up. The activities has already started. So it's also depending. We are also depending on the market. We don't generate volumes on our own. And if my sector, let's say, if a small example, a few months back, let's say if 3 months back, if I could have sold 10 lakh shares of Bajaj Finance, the impact could be 7 to 8%. Okay, and same thing I could have bought Grasim, the impact could be similar. Okay, so if I have to switch from, let's say, from Bajaj Finance to Grasim for whatever reasons, if my impact cost or the switching is going to be 14, 15, 16%, does it make sense when I'm talking about 12 to 15% return? So sometimes you have to understand the background is also important. If the market is not giving you that opportunity and is a risk off period, it does not make sense. Sometimes you have to lie low also. Okay. So it's not like every time you have to. That's the reason we use the word, we are student of adaptive asset allocation. We adapt the prevailing environment. If the environment is against you, no point. It's like if your pitch is not strong or weak, you can't play on front foot. You have
So you're
to
saying
manage.
now is not the time to lie low. Now it's like a risk
Again,
on.
it's coming
so
up.
now
It's coming back.
So now your
month
activity
on
has
month
started.
is rising. Yes, it's
okay,
rising.
Great. What strategy do you use to average down in case a trade goes against you? How long do you hold time-wise and draw down?
So everything is very dynamic. We don't work on averaging as a concept. We think it's a wrong thesis. Okay? We never try to average down. Okay. So either in quant, either we like it or we don't like it. It's a binary number. Okay. So a lot of people say I have reduced partly exposure, added partially. Okay, or reduced. So when we used to run our own broking company, we used to only buy, sell, or there's nothing like hold. Either we like it or we don't like it. Okay. So if we don't like, we exit completely. And that's the reason trend you will see in our most of our portfolio. We exit completely. If it had peaked out on my inflection points.
But till what level do you wait?
This is not the way. It's so dynamic. Let's say today market has risen sharply. Okay. And some of the stocks now from extreme neglected or certain reason now started trading at my territory. Some stock were like up 9%, 10% also today. This goes up another 6%. So from neglected, it started in the admired territory. From a near-term perspective, I may book profit. So I don't have a horizon of 6 months. What we thought will happen in 6 months is happen in 3 days. So I will look for that opportunity. So we don't define anything like this is a tenure. Okay, it's a opportunist house. So we always say, when we say as a quant is a style agnostic market cap, we are unconstrained fund house. So there is no constraint. We are pure opportunists. Wherever we see superior risk-adjusted opportunity, we'll play that.
Great way to live your life also, by the way. Pure opportunist, wherever you find opportunity.
You should be calm, People, see what happened during my when I joined Goldman, okay? Very interesting thing. I went, and not as an induction program, just met 75 traders of Goldman across the world. One thing I learned, very, very calm. In India, there's so much excitement.
Yeah.
In the dealing room, I went to Japan. Pin drop silence.
Really? I can't imagine that.
Or it's a pin drop silence. I was waiting for one of the partners for some discussion. I waited for nearly 90 minutes, you just have a call. And I went mad, what to do? 90 minutes you're sitting alone, okay? You can't interact from a regulatory, from a compliance perspective also. Pin drop silence. And India is very different. So that's the difference between an emerging market and a developed market, okay? So it's again a perspective. And second important learning, that they were very calm. They're more evolved people. Here the excitement is very high. We always overreact on both the sides. Okay, overreaction on the peak of the cycle, overreaction at the bottom of the cycle. So we get capitulated at the bottom of the cycle and we got sucked in at the peak of the cycle. This is what happens. This is something which I learned in talking to them. That's the reason, whether it's irrespective of market, our mood don't changes, Okay, we are same.
We overreact in everything.
That's the reason. This is something which we have learned, and that's the reason I don't get carried away with emotions. So that's the reason we have built numbers. Number has to guide us. These numbers or the indicators which we have built help us in difficult time. Like, 2 days back, when this drama was going on, Indo-Pak tension.
Yeah.
On multiple channels, I said it's a great buying opportunity, okay? And everybody was giving up. I said positions are not there, market is light, leverage position is not there. And whatever Trump tariff drama is going on, India is a beneficiary.
Correct.
We wrote last month newsletter saying that it is bad for US and China. It is not bad for emerging market, but it's good for India. Okay.
Why is it good for India?
Okay, because you have to look at absolute and relative. See, the money shifts on relative basis. Okay, so we, as a student of theory of relativity, we think everything is relative in life. The returns are also relative. Okay, so what is important is that when in US market, particularly I'm talking about US market, we have this thesis in 2025, the dollar index cycle will peak out, which looks like, okay, it's peaked out. And we have said earlier also that 2025, the decoupling process will start. So when I say decoupling, what it means, if risk appetite and liquidity has peaked out in US, the cross-border flows towards US from various countries were the highest ever, the complacency indicator or euphoric indicator, like complacency was the lowest and the euphoria was the highest in US market, and that cycle has peaked out. Okay. Now, if 10% money shift from high risk the US market to low risk Indian market, there will be tsunami in Asia centric emerging market, particularly India. I'm in that camp. That's the reason last month our fact sheet actually talk about title decoupling process begins. So it's already begin. Okay. So we are again decoding it mathematically. We are not saying that is our gut feeling. It's not our gut feeling. It's a number what is endorsing.
Okay, great. Lot of disgruntled investors because of the 1 year performance. I'm sure you get that a lot.
No, see what happened, the problem is with us because we created the expectation level so high in the past.
Expectation, disappointment cycle.
It's all about that.
Okay. Well, this is a generic question, an interesting one. 70% of all equity funds in the mutual fund space underperform the benchmarks. Why does it happen even after EMCs have the best talent and resources? Does this mean that a normal retail investor should forget about building his own portfolio?
So I think it's not fair to say that. Okay, if that is the case, then we don't need money managers and everybody can do it on their own. Okay, and a lot of people were very successful between 2020 to 2024, and maybe in last 1 year or 2 years, people have understood that they need qualified professionals. Okay, see, I think this business is all about cycles. Okay, it's mathematically and statically, I will say you will not get all the cycles right. Okay, so that's the way thesis. That's the reason when people talk about stock diversification or basket approach or country diversification or AMC diversification. So it's a combination which plays a role. So I think it happens sometime, but it should not be read in this manner. Okay, you have to rely on professional who specialize in this area, whether it's us or any other traditional mutual fund or active money managers globally. This is a specialized job, okay? So you have to be dependent on specialized rather than you saying, see, in some phase you have done very well, okay? If that is the case, then I always say that you keep small money, 10-20% of your capital for your own learning, 10% starting, 5%, okay? If you are successful, then you increase the ratio. So it's not fair to say that 1 year somebody has done bad or 6 months something has not done, I could have done better. It's a postmortem analysis is always going to be easy.
I agree. Okay, on your small cap fund, there are some complaints.
Yeah.
Harish has said that why their small cap fund doesn't have a downside protection compared to peers like Nippon and Tata. And as an investor, can we expect that in the near future, any plan to combat the same in the coming days?
No, I think the analysis is not correct. Okay, I always say when you look at our statistical measure in some terms of downside capture or upside capture, you will ask him to read our fact sheet, he will get answers. Okay. Most important thing, what is important is to understand how we manage the risk. Okay. Let's say example, a lot of people have complained that in the small cap you have Reliance and Jio in your portfolio, or L&T in your portfolio, or ONGC in your portfolio. Okay. Or so why is so? Because we say SEBI says that you have to maintain 65% small cap, 35% we have a flexibility. Okay. In a risk off period, we felt a portfolio diversification to large cap will be much better. Overall reduces my beta of the portfolio and gives me better liquidity for any event or any eventuality which plays out globally, or any redemption. That's the second thing. And more thing is when we work on our portfolio construct is a psychological game. Okay. If we are very comfortable, you don't tend to make mistake. And this is what happens when you run a very skewness in your portfolio for one theme, one thesis, then the problems start. Okay. So we think today, if you look at majority of the small caps were running towards very large exposure to a small cap. So right from July, we said, I have pruned down my exposure as a part of a strategy. So now in last 3 months, it has increased, but it has increased extraordinary. Answer is no, because it's not aggressive risk on. Some for mild to moderate risk on. So similarly, it will change. So we are very number centric house. If data points are changing, I will change my portfolio construct accordingly. I'm not in a hurry.
So you're saying that whoever is invested in the small cap fund should have at least a 5-year vision, 5-year time frame, and not look at it with a 1-2 year perspective.
No, and I always say that, see, this is what happens where a lot of debate was there in the last few months about the small cap thing, we should move out or not move out. I always say that if you go back in the history and you analyze even 5-year cycle, small cap has actually outperformed. And if we believe that India is a growth story, India is buy on dip story, India is a unique story which is playing out globally, then small cap will outperform, provided you have long-term horizon. Okay, you have relatively high risk appetite. If somebody has relatively high risk appetite and 5-year horizon, I will still say invest in small cap.
Okay. In fact, that is the next question. What should the strategy be for someone who's sitting with 80% cash now and waiting for a fall? It's understandable that no one can catch the bottom. So should we start investing now? If SIP, for how long? And if lump sum, at what level? Asking for a friend.
So this is a disaster case. So I will say, maybe start rebuilding. See, for SIP, you can start at any given time. If you have made a mistake also, you have to rectify it. It's better to rectify now rather than rectifying much later. So I think I will not say lump sum immediately because market has also rallied. But on SIP basis, somebody wants to invest, one should invest in India, because I always say something has changed for India from a longer term perspective. Let me give you a very interesting example. I have grown up in my 33 years of career is all about forecasting earnings. Okay, what will be next 3 years, 5 years? The entire industry works on next 3-5 years perspective. Okay, and based on that, people invest. Nobody invests on the trailing basis. That's a mindset. If there's no trigger, no growth, which you're talking about for Asian Paints. Now, the challenge of this thesis is that it is based on assumptions. Okay. On certain assumption, you are able to forecast. That's the reason every analyst assumption might be different, and there's a forecast number will also be different.
And human assumption. So there's a human error also.
Yes, correct. That's the reason you have positive surprise or negative surprise. Correct. Okay. What uniquely we have done is that we forecast earnings multiple, okay, which nobody does. We do it through a behavior indicator called perception analytics. Okay. how perception is changing. So we link perception with your P multiple in that sense. And perception analytics be a function of your leverage profiling, risk profiling, concentration risk. Many factor goes into it. So I have been saying that when I say something has changed for India, it means India perception analytics, both on absolute and relative basis to global market, is rising. Okay, and that's the reason I say India will remain expensive for longer term perspective. Our view is that if I have to talk about next 3 decades also, India will remain. So a lot of people have this thesis, India was expensive, it's still very expensive. Look at same FIs who sold 2 quarters or 3 quarters or 2 years back, okay, same are buying even higher levels. Why? Somebody says that India has become cheap. Not at all. It's all about relative thing. India has become, on the current environment, India is more safe. And hence money will come to India. Despite India is still expensive. So this perception analytics plays a very role in our entire portfolio thesis. When we construct our portfolio, earnings has some weightage, but perception changing or the rating or derating thing has a big multiple in our, big delta in our portfolio.
So you're saying now in this global situation, despite the de-escalation of the trade war and everything, India still has a big chance to benefit from the entire scheme of things. And in the medium to long term, there's a big upside?
Yes, 100%. 2, 3 reasons. One, say India perception has changed. Second thing, I said that money shift from high risk to low risk environment. So US market, we are more bearish on US market. Okay, from a longer term perspective, we think that cycle is peaking out, and hence money will start, and decoupling process already begin. I'm more bullish on the emerging market currencies also.
Okay. Okay, great. Just a couple of more questions before we end the show. Wow, there are so many questions.
Yeah.
Well, they're personal finance questions also, which I don't think I should ask you. When they decided to go with risk off in July 2024, why did the small cap fund fall so much? Imagine what would have happened if they still continued with risk on. The quant small cap fell in line with other small cap funds, even with risk off. So where is the risk management that they talk about?
So again, the problem with most of the investors, people don't understand the risk adjusted returns. Okay, their comparison is all about absolute and relative. Okay, they are not looking at the risk adjusted number. It will ask them to read our fact sheets and understand the risk adjusted return. See, it's a very simple thing. All these risk adjusted metrics are also not for 3 months and 6 months. Okay, these are also for 3 years, 5 years perspective. This is a cycle you have to look at complete. If you look at very skewed portfolio, our small cap has not fallen. We are similar to the benchmark, but from a risk perspective, our portfolios are more liquid. Okay, our beta of the portfolio is also on the lower side. Okay, and psychologically, the way we have built our portfolio is very constructive. You know, it gives you mental peace. We don't have illiquid names in portfolio where we will not get exit. So sometimes what people have to understand, the liquidity is also very important. When we talk about liquidity of country and stocks and sector, we will not look at the liquidity of our own portfolio. So in risk of portfolio, is liquidity is very, very vital. So I always say in risk on, the priority is first on return, liquidity is second, and safety is the last. In risk off period, safety comes first, liquidity comes second, and returns come last. So it's all about how you look at that.
Okay, well, you know what? I must admire you, Sandeep, for answering all of these questions. And I'm sure it's not been a easy ride for you because you haven't been able to sort of outperform benchmarks in the last 1 year at least. The last 5 years, you've given phenomenal returns to your investors. So I guess, as you said, right, expectations are very high, then disappointment is also high. But you'd want to leave us with a few expectations on what one can look forward to from Quant Mutual Fund.
The only thing which I want to leave with the thought process that we always say we are knowledge partner. Okay, we want to educate people, understand risk numbers. Okay, don't look at just absolute numbers. Okay, because see, whatever returns comes based on the risk. You take more risk, the probability of making more returns is on the higher side. Not all the time, the probability is on the higher side. So what is very important in a risk off environment, what is my risk numbers? Are we taking extraordinary risk? No, we are not taking. And that is something which we go and educate people, look at a longer term cycles. Okay, don't look at, see, Now, if I have generated extraordinary alpha, let's say small cap, my flexi cap 5 years have given 36 or 38% CAGR returns. Okay, where is the industry? Industry is less than 90. Okay, so if I look at average, will be double of the industry average. Okay, now you forget that period and then say, okay, only on explain me only on this period.
Okay, so
Then it's
let's
not
take
fair.
next 5 years.
Okay.
What are you assuming for next 5 years?
So I think if somebody has that 5 year perspective, invest in a small cap, the first point.
Okay.
Okay, if you have a 5 year vision, the problem is that people talk about 5 years, but they don't have even 5 month vision. Also, that's the problem.
They
starts.
start panicking in 1 year when the
Yeah,
fund
it's a
forms.
human psyche because,
Yeah, it is.
and this is the first time lot of retail participation has actually increased. I think the only advice I will give, India is a long-term story. Remain patient, okay, and do SIP on continuous basis. You will make good amount of money.
Okay, on that note, thank you so much for joining us on the Money Mindset. It was
Yeah.
really fun chat.
Yeah,
and
thanks a lot.
once again, thank you for fielding all of the questions
Mine is
with
our
so
pleasure.
much grace, with so much information. And I mean, there are disgruntled investors, as we've spoken about.
See, our job is to explain,
Yeah.
we can't change their mindset, and how we change, we'll educate through what you have to look at, and this is way we operate.
And you've had a 3-decade-long career. I hope
Yeah.
you continue to do great things with your career.
Thanks a lot. Thanks a lot for inviting us.